Hey everyone, I'm Mark and I'll be talking to you guys about plan curtailment and plan amendment accounting. And I thought the best way to do this presentation was to record me narrating while you guys follow along with the handouts that I've provided. Alright, so I'll begin by talking about accounting for plan curtailment. So, and as Brooke mentioned earlier, a plan curtailment is going to be a reduction of future service of present employees or the reduction of defined benefits. And the way I like to think about a curtailment is when all said and done, in either situation, it's going to lead to a reduction of accrual of benefits. So, if we have a curtailment that decreases pension benefit obligation or PBO, and which we hope it would, because that's kind of the point of a curtailment, then it's going to be a gain. And that makes sense, right? Because if we have a decrease in obligation, it's going to be a gain for us. That gain is then first offset by any net loss we have in AOCI. So what we're going to do is we're going to go to AOCI, see if we have a net loss, and then run that gain through that net loss. If there's any remaining gain after we ran it through the net loss in AOCI, that's going to be a curtailment gain. All right, so you might be thinking, what if there is no net loss in AOCI? What if we have a net gain? Well, then that entire gain from the curtailment is going to be classified and recognized as a curtailment gain. So what would happen if we had the opposite situation? What if we had a curtailment that somehow increased our PBO? And again, this doesn't happen often, but it could happen. If the curtailment increases PBO, then it's going to be a loss. The loss first offsets any net gain we have in AOCI, and then the remaining loss is a curtailment loss. And then if we don't have a net gain in AOCI, then all that loss is a curtailment loss. So the way we account for it is exactly the same, but that kind of gives you a picture of opposite situation. So if you go on to the next slide, I provide an illustration because when you explain these accounting rules with words, they might kind of make sense, might not, so it's easier to kind of understand when you apply some numbers to it. So if you go to where it says pension benefit obligation, and I have circled or boxed that, and then you look to your right, it's going to show you the PBO before and after the curtailment. If you notice, after the curtailment, our PBO decreased, and it decreased by that amount in between that 110 that's boxed. So, as I mentioned before, that 110 is going to go through two steps. First, we're going to go down and see if we have any net loss in AOCI. So we go down, if you look in your bottom left-hand corner, there's a 300 labeled as net loss. That is not actually the net loss. That's the net loss that our example provides us with. That net loss is going to be netted with the transition above it, but we're not going to worry about that because transition asset is something that's left over from FAS 106 when it was declared back in 1990. So we're not going to worry about that. We're going to worry about the number below the 300, which is 100, and that's going to be our net loss. And if you're curious, transition assets, they're treated as a net gain. So we're gonna net those two amounts, and we have 100. We're gonna take that 110 that's boxed up in the middle, and we're gonna offset that 100, leaving us with no net loss. And then that remaining 10 from the 110 is gonna be a curtailment gain. So then, if you go on to the next slide, I provided the journal entries. And again, this is pretty straightforward. Your pension asset, you're gonna debit it for 10, and then you're going to debit your liability for 100 because you're decreasing your liability, and then you're going to credit gain from curtailment. Like I just mentioned, we had that 10 that was a curtailment gain, so we're going to credit that, and then we're also going to credit OCI net loss for 100 because, as I showed you in my example, we got rid of that net loss. And then the journal entry below kind of gives you an example of what would happen in the opposite situation. I'm not going to go over it, but that's there for you guys to look at to make better sense of it. All right. So now I'm going to talk to you guys about accounting for plan amendment. And Brooke mentioned a little bit about plan amendments, and then Travis will talk to you more about plan amendments, but I'll go over it so then my example will make sense to you. So, plan amendments applied retroactively. So, if the plan amendment retroactively increases the benefits, then your PBO will increase, right? You got more benefits. That the cost of the benefit improvement is going to be recognized as a prior service cost, or PSC. PSC is going to be recognized in comprehensive income at the date of the amendment, and then it's going to be PSC is amortized as a component of net periodic pension costs in equal amounts for each period. So what do I mean by equal amounts in each period? Well, there's two ways we can amortize PSC, excuse me. We can do it, we can amortize it straight line or at a declining rate. And the period that we amortize it over is going to be what the company, or how long the company expects its employees are going to stay with the company, or if there's an inactive employee, so a retired employee, they're going to measure that period by their life expectancy. So we're going to take how many years we think our employees are going to stay, or their life expectancy, and amortize PSC across that period using straight line amortization or a declining rate. And OCI is going to be adjusted each period that your PSC is amortized. So if you look at the next illustration, just kind of an outline of how the amortization works. If you look at the column that says amortization, you'll notice that they're not equal amounts, but the rate that we use is going to, the numerator is going to be how many years we expect our employees to stay for that period over the total amount of years we think all of our employees are going to stay with the company for all periods. So we just apply that rate, we get our amortization for the year, and just kind of work our way down. And you notice that the amortization amount is a declining amount. Whereas if you look onto the next illustration, we just straight line it, just what we're used to, and have an equal amount each period. Alrighty, and that's all I have for you guys. Thanks for listening. If you have any questions, I'm sure Brooke or Christina will be more than happy to answer them.